Pause whatever you're doing for a moment, because what unfolded last Friday was not your average pullback. This wasn't a routine dip or a healthy reset. It was a carefully engineered trap. Ex-gold slipped quietly, silver took a full-force hit, and the rest of the precious metals complex, platinum and palladium, collapsed in sequence like falling dominoes. And here's what most people are overlooking. This move was not random. It was deliberate. And the next 48 hours may determine whether silver miners turn into an opportunity of a lifetime or a capital graveyard. Before we go any further, a quick note. We now have over 1,000 members who receive daily members-only videos and early access to every upload on this channel, so they stay fully aligned with market developments in real time. If you want to stay as updated as they are, you can join by clicking the link in the description or tapping the join button below. It takes less than 30 seconds. Earlier today, I focused on the gold side of this story, what the crash means for gold and the companies that extract it. This video is the silver follow-up. Same storm, different battlefield, and honestly, higher stakes. Silver doesn't behave like a normal metal. It trades like emotion. It moves like a mood swing. Before we even talk about miners, we need to clear through the noise. There's a rumor spreading fast that a major Wall Street bank closed all of its short positions right at the lows. The story claims they smashed the market lower, quietly covered at the bottom, and are now about to unleash a powerful upside move. It sounds dramatic. It sounds satisfying. And it spreads quickly because it feels like a perfect movie script. But here's the problem. Most people are looking at the wrong document and they're interpreting it incorrectly. And there's another critical detail almost no one mentions when they share those screenshots. That report only covers a single delivery month, one slice of time, one hallway inside a massive building. Even if you could perfectly identify who delivered and who received metal on that specific day, it tells you nothing about what's happening in the following months, where most open interest actually lives. It also doesn't tell you how long those positions existed. A contract could have been opened years ago or hours ago. That's why I don't treat delivery data like a crystal ball. It's a temperature reading, not a prophecy. Deliveries can increase for many reasons that have nothing to do with some cinematic short covering narrative. A large industrial buyer may choose to lock in supply early. A fund might decide to take physical metal instead of settling in cash. A broker may simply be netting client flows. All of these are real, ordinary explanations. So when a rumor goes viral, ask yourself a simple question. Is this information or is this entertainment? Because markets punish anyone who confuses the two. Every trading day, the futures market publishes a straightforward report showing who delivered metal and who received it for a specific contract month. It's not secret code. It's not a confession. It's a receipt. People saw the name of a major bank attached to a few hundred contracts and immediately shouted, "They covered." But receiving metal is not the same thing as closing a short. Think of a futures contract as a promise. When that promise expires, it can be settled in cash or fulfilled with physical delivery. Seeing a bank on the receiving side means its broker arm was involved in taking delivery, possibly for itself, possibly for a client, possibly for a manufacturer, refiner, or fund that wants physical bars instead of paper exposure. What it does not automatically mean is that the bank closed a short position. In fact, receiving metal aligns more closely with being long into delivery, which is the opposite of the narrative spreading online. And even if we assume, for argument's sake, that a few hundred contracts were related to short exposure, let's keep perspective. A few hundred contracts are insignificant in a market dominated by massive balance sheets, layered exposure across months, options, swaps, and off-exchange instruments that never appear on a daily delivery line. So if your entire strategy depends on a single screenshot, pause. The real questions are different. What did price actually do? How did miners respond? And what happens when earnings reset expectations? Friday's move was brutal. Silver collapsed in a single session, slicing through levels that had only recently been reclaimed. It felt like the floor vanished, the kind of price action that makes your stomach drop. But zoom out slightly and something interesting appears. Silver finished Friday near the same price zone it traded around roughly 2 weeks earlier. In other words, the market erased part of the recent surge, not the entire trend. Now look at the Silver Miners ETF. A basket of larger silver producers. It fell as well and landed near the same area it traded when silver was at this price level previously. On the surface, that seems logical. Same price, same valuation. But that conclusion misses something critical. 2 weeks ago, the emotional environment was completely different. Momentum was building. Traders were chasing. Options were being bid aggressively. Confidence was high. Today, fear dominates. Stops were triggered. Weak hands were flushed. Volatility surged. And when volatility rises, the market reprices risk, especially miners, which are leveraged expressions of the metal layered with operational risk. So yes, the price may look similar, but the psychology is not. And psychology determines whether Monday becomes a relief bounce, a bull trap, or the beginning of something larger. Make no mistake, Monday will be violent. Expect candles that look like heart monitors. 1 hour will feel like the worst is over. The next will feel like everything is collapsing. Trying to day trade that environment can shred accounts, even if you're directionally correct. After sharp moves, markets follow a familiar pattern. Panic selling exhausts itself. Bargain hunters step in. Price jumps. That jump triggers fear of missing out. Late buyers chase. Then price snaps back, stops get hit again, and the cycle repeats. It's not linear. It's a yo-yo designed to punish impatience. If you were forced into cash on Friday, you're not alone. Many people didn't choose cash. They were pushed into it. Cash feels safe briefly. Then reality sets in. Governments run deficits without restraint. Debt expands. Currency supply grows. Purchasing power erodes quietly. The grocery store doesn't lie. So people look at cash and feel pressure to act. And Monday feels urgent. But here's the truth. Monday may be the worst day to make an emotional decision. It's the day the market tests discipline. I'm not buying Monday. I'm not selling Monday. I didn't time the crash perfectly, and I'm not pretending otherwise. But here's how I think about it. When paper prices collapse, I ask one question first. Did my physical ounces disappear? The answer is no. The metal didn't vanish. The screen changed. Screens lie in the short term. Can price go lower? Absolutely. Markets can stay irrational longer than expected. But if silver hadn't surged so aggressively beforehand, Friday wouldn't have felt catastrophic. It felt extreme because the run-up was extreme. That's why separating emotion from structure matters. So let's talk structure. Should you buy silver miners here? There's no one-line answer because miners are businesses, not metals. They have costs, management teams, debt, jurisdictions, and dilution risk. A metal bull market can still destroy poorly run miners, but it can also dramatically reward well-run ones. Many primary silver miners aren't pure silver plays. They also produce zinc, lead, copper, and gold. That diversification can cushion downside or amplify upside depending on market conditions. Costs matter. Cash costs, sustaining costs, all-in costs, labor, fuel, maintenance, royalties, reinvestment. The real question isn't just where silver trades, but where it trades relative to a miner's cost structure. Markets don't wait for earnings. They front-run them. After crashes, expectations often reset before numbers appear. Think in sequences. The last reported quarter reflects lower average prices. The next quarter begins to show higher realized prices. The quarter after that compounds the effect. That's where the opportunity lies, when the market panics out of miners just before estimates turn upward. But skepticism is healthy. Higher silver prices don't guarantee higher miner prices. Operational issues, political risk, energy costs, financing problems, and dilution can destroy returns. This isn't a fantasy. What matters is margin expansion. If realized prices rise faster than costs, earnings surprises become more likely, and earnings surprises re-rate valuations. Silver isn't just an investment metal, it's an industrial input. Electronics, power systems, solar manufacturing. Industrial demand doesn't vanish overnight. It often appears with a lag. Now, let's get practical. If you're trading one-day bounces, you're competing with machines and chaos. If you're positioning for quarters, focus on survivability and margins. Low debt, cash reserves, stable operations, costs under control, energy costs matter, labor matters, currency exposure matters. These factors explain why miners often move differently than the metal itself. For Monday, don't expect clarity, expect noise. Watch whether silver stabilizes, watch whether miners lead or lag the bounce, watch whether panic volume fades. Big moves often occur when attention fades. That's not mystical, it's positional. Let's touch macro briefly. Silver responds to real interest rates. When real rates compress, metals gain appeal. Currency instability, dollar swings, and policy uncertainty all feed into this dynamic. Also watch adjacent businesses. Streamers, refiners, recyclers. Their models respond differently during drawdowns. Markets love heroes and villains. Reality is leverage, positioning, and forced flows. Friday exposed overconfidence. Markets don't care what should happen. If you're in miners, you need a plan that survives being wrong. Smaller sizing, scaling, quality over lottery tickets. Let me ask you two questions. Do you think Friday was a one-day liquidation or the start of a larger unwind? And if silver rebounds, are you buying miners, physical, or waiting for earnings? Drop your answers below. Now back to miners. Earnings are delayed echoes. Guidance matters, cost control matters, capital discipline matters. If I were building a position, I'd layer it. Core names first, mid-tier second, speculative names last, if at all. Same price doesn't mean same deal. Information changed, risk changed. Bull markets climb walls of doubt. They punish impatience and reward stillness. Physical silver didn't disappear. Neither did ore bodies. The vote changed, temporarily. Margins drive re-rating. Production per share matters more than production growth. Leverage creates fragility. Air pockets happen. They end. Cash buys time. Time matters, but indecision costs too. If you can't explain an entry in one sentence, you're not ready. Minor math is simple. Margin is everything. Big moves often happen when assets look unbuyable. So here's the bottom line. If your horizon is short, Monday is dangerous. If your horizon is longer, this volatility may create opportunity, but only with discipline. Watch price behavior. Watch miners relative to silver. Watch volume. Watch earnings. And watch yourself. This is education, not advice. Think independently. Stay sharp. Stay humble. Don't let a screen bully you into bad decisions.